Okay, let's continue. Asset valuation, part two. Use fundamental analysis to pick a stock. Do all the necessary research yourself. You have to make a decision yourself. You need to look at the numbers. Again, look at the market. Look at the newspapers. See if actually people like this, what they're producing. Is this something good? Is this something that people would buy? It could be a product or a service. Is it like a tourism industry in some faraway country? Would people actually want to go there or no? They just don't want to do that. Then rely on the advice of Wall Street analysts. These folks are professionals. Now you need to be careful. Sometimes they just want you to uh, just buy stuff because they get commission or they just want to uh, increase their trade, the number of times people are buying and selling stuff. But sometimes, most times, they give you genuine advice. Or buy a mutual fund. The manager conducts fundamental analysis and makes the decision for you. This is the case for retirement funds. Very, I would say, low risk in most countries, although in Iran, the teachers' retirement funds ended up to be a huge fraud. Some movie making companies, they actually use the money, like they kind of had these shady deals with the managers of mutual funds for teacher retirements. And they took all this money that they say we're going to make movies and these movies are going to sell huge profits. And then some airline companies would also enter this shady deals. They would say, yeah, let's have these funds invested in our corporation. We are going to give teachers 5% discount for airplane tickets and things like that. It became a disaster. Government actually had to step in and rescue the teachers' retirement funds at the end. But still, in most countries, it's pretty low risk. It's pretty sure. Most of these mutual funds are backed by the government, so they cannot actually fail. One very good example I studied on my master thesis is the Norwegian retirement fund or pension funds. They invest in the Norwegian oil industry, and I think Norges Bank, it's called Norges Bank. It's the richest pension fund in the whole world. It's one of the richest investment firms in the whole world. Hugely successful. So this is another option. The efficient market hypothesis. Asset prices reflect all publicly available information about the value of an asset. When we said the market is an efficient market, it means nothing is hidden. Everything is on the paper. I tell you honestly how much money I'm making, how much money I'm losing, what are my revenues, what are my costs, this is my profit, and other different sectors in the market are also completely transparent. Each company listed on a major stock exchange is followed closely by many money managers. So they cannot actually do shady stuff. They're followed closely. People look at them. If there is a problem, they sound the alarm. Immediately, if they see something is about to go wrong, they sound the alarm. Equilibrium of supply and demand sets the market price. That's the efficient market. Stock market, it exhibits informational efficiency. Informational efficiency, description of asset prices, rationally reflects all available information. So one of the good things about the stock market is that you can have information. If you see the stock market, you always see these tens of hundreds of people with phones screaming at each other, but on the board you see tons of numbers. Now, these numbers are information. It's transparent, it's available to you. You can see in real time if you're following a company. Each one of these guys is following a certain company, which is they're always shouting and screaming on the phone. It's because they're trying to buy and sell things. This is the efficiency, the informational efficiency. Everything is transparent, everything is available, so you can make the right decision. Nothing is hidden. There is no skeleton in anybody's closet. Rationally reflect all available information. Implication of efficient market hypothesis. Stock prices should follow a random walk. Changes in stock prices are impossible to predict from available information. What does this mean? Changes in stock prices are impossible to predict from available information. It means that if something's about to change that can be seen by someone, this change can also be seen by everybody else. And then immediately these people would start reshaping supply and demand. So, for example, I'm the CEO of a Ford Corporation. I make a big mistake. The company is about to go down. I cannot hide it. Everyone will see it. And immediately they will react to it. So by the time, just in real time, in a split second, the prices will readjust so fast that it's like nothing ever happened. Changes in stock prices are impossible to predict from available information. Therefore, what you have is a perfectly random market. No one can actually predict the future because everyone can predict the future. That's the beauty of it. If everyone can see the information, then no one can actually benefit from using that information because everyone would quickly react to it. If I tell you, hey, price of Apple Corporation is going to increase by 10% tomorrow morning. If I only tell you, you're going to buy a lot of Apple Corporation stocks. But if I tell everybody, then everyone will come and buy Apple Corporation stocks to benefit from that 10% increase in tomorrow morning. That creates more demand for the stocks, so much that would immediately increase to that level. And then demand would go up, supply would come down, and price would actually reaches an equilibrium. Everyone would see what's happening here. Diversification. In general, absent any inside information. Inside information, nothing. It's transparent. An equity investor can expect to do better by choosing a well-diversified, low-cost indexed fund than by picking only a few stocks. As you can see, almost everybody agrees. Try to diversify because the remaining risk when you don't have any inside information is just random events, things that we cannot predict. So in order to ensure ourselves against these random events, we need to diversify. For example, very good example of these random events is the virus we're dealing with right now. No one could see this coming. There are new reports that people would have been warning about this virus as early in November. I'm pretty sure in the coming years, we'll see tons of lawsuits. People will sue each other that you know about this and you made tons of money on this and you abuse this. These stuff will happen in the next few years. That's my prediction. Tons of lawsuits at the very least is going to happen. But then, because us couldn't know that some virus would shut down the world's economy, it's completely random. So it's better if you diversify. If I had, let's say, not all my money invested in the stock exchange, and I had like 2 houses, a safe investment, some gold, things like that, I could have protected myself better. I would have diversified. The efficient market hypothesis, theory about how financial markets work, probably not completely true. Because yeah, let's face it, we're human beings, we're not perfect. There are always people who have this cousin in that company, who know that guy from there, who have been co-workers before, who saw each other in a party last week, talked with each other over a beer. They know something that we don't know. Evidence on the stock prices, even if not exactly a random walk, very close to it. Why very close? Because you have all these geniuses. These folks are geniuses in Wall Street. They're all like mass geniuses, number geniuses, statistic geniuses, economic geniuses, finance geniuses. They're the best of the best. Of course, I still haven't joined them, so they're lacking me. But these guys are the best. And if there is something that's happening and it can be seen, they're going to see it. And they're going to readjust the market supply and demand so that, in a sense, it just disappears. Very close to it. There are still rooms for error. Have you ever watched the movie The Big Short? It's about a guy who's trying to warn about this statistical problem in insurance companies and housing market that was creating a disaster, and yet no one could possibly see it. This guy, he was a physician, he was a physicist, super intelligent guy, very good with number. He looked at this and he was okay. There is a problem here, and no one was listening to him. The whole time he was warning, okay, there is a problem, something's happening, and then the 2008 crash happened. So if it's not exactly a random walk, it's as close to it as possible. Index fund, mutual fund that buys all the stocks in a given stock index. Active funds, actively managed mutual funds. Professional portfolio management. So a professional is using your money, running your investment for you. Buy only the best stocks. Performance of index funds better than active funds. I would say it's because of low risk, high risk, high reward. Although I'm not very familiar with the active and the other one, the index funds and active funds. Active portfolio managers, lower return than index funds, trade more frequently, incur more trading costs, charge greater fees. Only almost 20% of managers beat the market. It's a very important statement. I think it's contradicting the previous statement. Active funds buy only the best stocks, and then only 20% of managers beat the market. This is very contradictory. Not very familiar. I've never worked. I worked for a short period of time in stock exchanges. I never actually worked in these active portfolios and index portfolios, so I don't have a story to tell you. I just see a contradiction here myself. Efficient market hypothesis assumes that people buying and selling the stock are rational. Process information about the stock's underlying value. These people, we assume they're smart, they're rational, they information is completely transparent and available. They take this information, they process it rationally, and then they make the best decision. Fluctuations in stock prices, partly psychological. Now, we have a field in psychology, it's called financial psychology. In financial psychology, people actually study human psychology when dealing with fluctuations in the stock prices. One thing that I remember from my master's degree is that in financial psychology, we have this problem with the good news. People only want to see the success story. We all heard this. I don't know if you like sitting with your dad or your mom and your aunts and uncles and everything. They're always talking about this, company made huge money. That guy entered that market, made tons of money. That person started a business, fluent, billionaire right now. We all focus on good stories. No one ever want to talk about the bad stories, the failures. Bitcoin, very good example. You always hear people talking about Bitcoin is big, people making big money on Bitcoin. Bitcoin is successful. Bitcoin is the dream. No one talks about all those millions of people who invested in Bitcoin and then Bitcoin crashed, because Bitcoin is always on a roller coaster. No one can see what's going on. No one can see where is the market. Like, I don't know, when I'm buying Bitcoin and selling Bitcoin, who is on the other side? Is it like a multinational arms dealer in the South Pole? Or is it an international drug dealer in planet Mars? Or is it just another person like me? I don't know. So information is not transparent. That's why Bitcoin is always this roller coaster. No one knows what's going on. And we all focus on the good news. That's because of the financial psychology. No one sees the bad news. In order to make a rational decision, you need to both look at the good news and the bad news. It's very important. I know for a fact that I don't have the talent to do this. Whenever I played poker with my friends, at first, when I'm playing and I'm winning, I'm very rational. But when I start losing, I get all these crazy things going on in my head that it's my luck, and I get angry and I all in, break down the whole thing. So some people, they have nerves of steel. They're very rational. They can look at the good news, the bad news. They can make rational decisions. Some people don't. When price of an asset is above its fundamental value, market experiences a speculative bubble. Possibility of a speculative bubble, value of the stock to the stockholder depends on stream of dividend payment. Final sale price. You need to have something real. You're either being paid dividend or your stock actually can be sold at a good price right now in the market. If you're constantly losing money, no dividend is being paid to you, and your stock price is going down, then probably that's not a good investment. Probably you're relying on a bubble. Now, question for you, for debate: frequency and importance of departures from rational pricing. Market irrationality. Movement in the stock market is hard to explain. News that alter a rational valuation. Efficient market hypothesis, impossible to know the correct rational valuation of a company. If it's actually impossible to know, then what do we have? How can we make an informed decision on buying or selling the stocks? Or movement in the stock market, is it really hard to explain? News that alter a rational valuation? Let's look at today's world, for example, this coronavirus. Can we say that the market just crashed and the economy just evaporated? What if the economy comes back and people start making tons of money on their stock returns? Then why would people actually lose money before? If they just wait, they just come back, the market would come back and evaporate lots of their loss. I don't know. I really don't understand these stocks that much. They're really complicated and weird thing. I don't like the work these guys do, constantly shouting on the phone. But if you're interested in this subject, send me an email. Let's talk about this. What do you think? Especially about the crisis we are right now. Let's talk about this. Do you think the stock prices will actually come back? Or do you think the world economy has just lost a big portion of it and we have to just start over? Like 10 years ago, we have to just start over and rebuild the economy step by step. I don't know. Thank you very much, everyone. Take care.